brought to you by YEARN. YEARN is DeFi's first self-building community-run project, which I just get really, really excited about. YEARN is a system that seeks out yield in DeFi, and it does that in a number of different ways. A very aggressive way is with the vaults, where you can deposit your preferred asset of choice, and different DeFi experts will come in and generate a strategy for what to do with your deposited token, right? And so it'll go find ways to get yield in that deposited token in DeFi. For those who want to just earn yield on their stablecoins, the EARN system is for you, where you can deposit your preferred stablecoin and YEARN will go and figure out which money market on DeFi in DeFi is producing the best interest rate, whether it's DYDX, it's Compound, or Aave. It looks around DeFi to see where the yield is coming from, and it directs stablecoins automatically so you don't have to. Check them out at yearn.finance to get started, and also check out the stats page to see what other people are doing as well. We're also brought to you by MONOLITH. MONOLITH is your cool new DeFi account, your DeFi savings account, your DeFi checking account. Except the cool thing about the MONOLITH DeFi account is that it gets software updates, right? You actually get to increase the usefulness of this over time. So here are some of the features. MONOLITH is a smart contract wallet with a lot of the features that you would expect if you've come to know DeFi and what it is. You can add money to it. You can put that money to work in Compound and accessing yield. But you can also swap through Uniswap. What was cool with MONOLITH is that they will send you a very sexy MONOLITH Visa card that connects to your MONOLITH smart contract wallet on Ethereum. So it's a really awesome tool to live a bankless life with a savings account that gets software updates. So this is something that you're never going to find out in the real world, but you can still do real world things with real money, like buy your groceries. So that's just fantastic. Coming soon to MONOLITH, actually already here to MONOLITH, is now you can buy DAI and get it sent to your wallet directly, right? So it's also being an on-ramp. So you don't have to go through your centralized exchange like Coinbase or Gemini or wherever. You can just go straight from your bank account right into your MONOLITH checking account smart contract wallet. So check them out at monolith.xyz.
All right, Bankless Nation, we are back to talk about the Q3 DeFi token report, and we are joined by Lucas Campbell, who is a Bankless editor and analyst on our team, puts out these fantastic reports every quarter. Lucas, how you doing, man?
I'm doing great. Thank you guys for having me.
Oh, well, it's great. It's great to have you, my friend. So we want to dig into this token report. And of course, aside from yourself, the other party that really made this possible is our token report sponsor, Diversify, which is a killer decentralized exchange for serious traders. It's private transactions, instant settlement, all the bankless way. They're doing some really cool stuff with layer 2, particularly Starkware, to make all of this really fast. With solutions like Diversify, I feel like you don't even need a central crypto exchange anymore. We will include a link to Diversify where you can start trading on it in the show notes, and just want to thank them for making this report possible.
One of the first companies to really get onto a layer 2 up and running, and I used their exchange like really quickly when they first like launched, and like the UI was pretty simple, pretty easy to use, but then it's already like become so polished over the last like 2, 3, 4 weeks. So big fan of Diversify.
You can't even tell they're a decentralized exchange. There was a time where you could like tell, oh my God, this is a decentralized exchange. Right. Like, brace yourself for a clunky user experience. It's not like that anymore. All right, Lucas, we've got the report open. We want to talk about some of the highlights, man, that you saw. So this is the report that we issued on Bankless. We've got it, of course, in a web version, but also this cool institutional Wall Street grade PDF version. And you've called this report, Lucas, The Rise of the Ownership Economy. Can we dig into that name? So why'd you call it that?
Yeah, I mean, I think that's a great question. So you guys talked about this a lot last week with Jesse Walden and the ownership economy, but really the name came from this mania, this yield farming mania that happened in Q3, where the core idea was give ownership to the users, right? So it would be like the equivalent of, like, let's say Uber distributing equity to anyone that gave or took an Uber ride, or let's say like Google giving out shares to anyone that used that search engine. So like the equivalent of this in DeFi is how Compound gave comp tokens, which, you know, pretty much kickstarted the whole mania. They gave comp tokens to anyone that provided liquidity or borrowed assets from the protocol. And that pretty much just kickstarted this insane quarter that we can kind of just see in the data. But yeah, I mean, the rise of the ownership economy is really just this core notion of giving ownership to the users and making them, you know, the stewards of the protocol over the long term.
All right, and it was an insane quarter. You know what? Let's just get right to the quarter. I want to come back to the shift from price to earnings, PE to price to sales, because I think that's important. Just you know, as far as a takeaway. But let's get into this insane quarter that we saw, and here's kind of like the, you know, the money headline here. But we saw a quarter to quarter revenue increase for these DeFi tokens. We call them capital assets because they're similar to stocks in their ability to potentially in the future produce cash flows. So they can be valued as such. But the revenue increase was 26x from last quarter, right? So this is the graph. These are all quarters here. Q1, Q2, Q3, Q4, and then, oh my God, here's Q3. It's like massive. So we went from 3.9 million in revenue created by these DeFi protocol tokens to 108 million revenue created by these DeFi tokens in Q3. Is that the ownership economy, the yield farming mania that you were talking about, is much of the growth as a result of that?
Yeah, I mean, definitely it was a lot of that. I mean, Uniswap was like a big contributor to that. So a lot of people were, you know, trading DeFi tokens, were swapping in and out of tokens. You know, a lot of the yield farming protocols like featured Uniswap LP tokens. So like Uniswap is obviously like the biggest contributor with $67 million in that quarter alone distributed to liquidity providers.
Wow. Okay. And then who are the big token winners for the quarter? I guess, is this a graph of, this is still a graph of quarterly revenues. Is this a change from previous quarter, or is this just, you know, in general, what's this graph looking at?
Yeah, so that is the DeFi price or the token price performance throughout the quarter. So between July 1st and September 30th, Aave was the biggest gainer with 300% increase. I will caveat that with saying that YFI was probably the real gainer, but it effectively went from 0 to, you know, $1 billion. So it was like an infinite gain. So I couldn't put that on the graph, but yeah, Aave kept its lead. It had a really awesome quarter in Q2 as well. And it just kind of kept going off the back of the Aavonomics upgrade, which is like this major overhaul to the token economics and introducing decentralized governance and some yield farming mechanisms and a whole bunch of other stuff.
So Aave, again, with 300% revenue growth in their DeFi token. What were a couple of the others? So there's two more that are above 100% growth. What are they? Yeah,
so the other second biggest one was Loopring, which I think a lot of DeFi investors were kind of getting tired of the gas fees on Ethereum, and we're definitely looking towards like layer 2 solutions. So like I think another notable one that wasn't necessarily depicted on the graph was like Omisco, OMG, had a really awesome quarter from what I remember. So I think like a lot of DeFi investors were looking towards layer 2 as like an opportunity to like capitalize on like the increase in gas fees and just like the lack of usability for Ethereum during that time period. I don't know if you guys remember that, but like you were paying, you know, hundreds of dollars in gas fees to get in and out of like, you know, different yield farms.
Absolutely.
The last one was Synthetics there with 155% gain. And I mean, Synthetics is always just pushing out new stuff. They're constantly you know, releasing upgrades. They were the best performing token last year in 2019. They had like, you know, a meteoric rise. And they're just kind of piggybacking off that momentum and keeping the train rolling here.
And also one of the first apps to also leverage layer 2 as well, right? So like Loopring, itself is a layer 2, but Synthetics is an application, but is now kind of pushing the envelope with getting applications onto layer 2s. So interesting to see, like, you know, no one's gonna point at some price increase in Synthetics and say that's not because of exactly what Synthetics deserves, But also what they deserve is because they are the ones that push the envelopes and move really fast and get onto L2s as fast as possible when it's necessary. So, tip of the hat to those guys.
Yeah, I mean, they're definitely testing the optimism test net right now. And you can stake on it right now, and they're incentivizing it, the whole work. So definitely check that out and see if you're eligible.
It does feel like the tokens that are building more are doing better in general. Like Aave, that team, just like always building, always releasing things. So same with synthetics. So I mean, the builders have really won over the past year. Really quick before we kind of talk about ETH as a DeFi asset as well, and then break it down, these DeFi tokens by segment. Let's talk about the shift from price to earnings to price to sales and what that sort of means, right? So when you're evaluating a capital asset like a stock, investors tend to use this price to earnings ratio, which basically tells you how much you are paying when you buy that stock for every dollar of earnings. So a Netflix might be around 80 price to earnings ratio. That means you're paying it around $80 for $1 of earnings. So you're anticipating that it's going to continue to grow in order to justify a price to earnings ratio of 80. And we've done a lot of work in the past kind of looking at these DeFi tokens from that lens, because it can be evaluated from that lens. How much money are you paying for every $1 earned in by the Aave protocol, for instance, right? And that can be a relative valuation metric that's useful. But there is kind of an asterisk there in that a lot of what we're looking at is not like bottom line earnings, like profit. But when we're talking about revenue for these DeFi tokens, we're actually looking at top line revenue, actually their sales revenue. So that's sort of the lens. It's not so much price to earnings, it's really price to top line sales, because there can be other costs, before you get to sort of the bottom line revenue. Is that a good way to summarize it, Lucas? Or like, what would you add on that concept here?
Yeah, I mean, exactly. I would say I think the best way to think about it is like price to earnings is the profit that is accrued to the protocol's token, whereas price to sales is really just the revenue generated from like usage of the protocol, right? So I think like a really good example of this is Kyber. So the liquidity protocol, generated, I think it was like $10 million in revenue off of a 0.2% trading fee. And right now, governance dictates that 73%, give or take, is accrued to KNC holders via like ETH dividends, and then a small amount of it's burned. Whereas the remaining 26.5% is distributed to like reserves, which are kind of like the Kyber's like liquidity providers almost. So you kind of see that distinction, whereas like Kyber's price to sales is 21, whereas their price to earnings is a little bit higher because only 73% of that revenue is accrued to the token. So the price to earnings is 29.
That makes perfect sense, right? So, but on that, so like we've got a price to earnings of 29, a price to sales of 21, a little bit lower, but price to earnings of 29. By the way, that just seems super low, right? Like high flying tech companies right now on the NASDAQ are going for PE ratios of like, 80. Amazon's like 160, 170. I don't know what Zoom is. What's Zoom, Lucas, these days from a price to earnings perspective? Like
411 right now. Yeah.
411 right now. That's the Zoom stock that we're using Zoom. So fantastic. For them, but that's a pretty high valuation metric.
Using their product to tell them that their valuation's really high.
Right. Well, the product could be great, but the stock price could be high relative to what it's worth. But anyway, are we seeing a lot of very low price to earnings ratios like Kyber? I mean, just that seems super cheap still for the potential growth of DeFi's. Is that the case?
Yeah, I mean, I would say so. I would there's a couple that are like a little bit more nuanced, like Uniswap and Compound, and a few others aren't actually like generating any earnings for token holders. It's all revenue. With that, like Maker was another notable one where right now they're generating $80,000 per day, and they don't have the DSR on, so they don't have that DAI savings rate. So all of those revenues are being allocated or directed to MKR burns, right? So I think in the report, it was like, they're at a new low of a PE ratio of like 30 or something. So you're definitely seeing like the protocols that do accrue value to token holders that have like that mechanism, they're definitely hitting, new lows, or they're on the lower end, especially when we're looking at some of these other tech stocks that are, valued at like sky high valuations.
Was there a place in the report, Lucas, where the PE ratios are that we could see, or the price to sales ratios that we could see?
There
for the
was a
tokens?
price to sales ratio. I did not do one on the price to earnings, just because
Got
it
it.
was like a lot more nuanced to
Where's the
kind of
price
dig
to
into that.
sales? What page? I'm gonna pull that up if I can.
Should be, let's see, scroll up. It was in that first section, like the DeFi overview.
Ah, must have missed it. Okay. So what does that mean? I'll scroll up to find it, but what does that mean for a token like Uniswap, for instance? It's almost like a Uniswap is clearly there's value there, but it's almost like pre-revenue. It's almost like Facebook.
Right.
Well, it was building network effect and acquiring users, but it hadn't yet turned on its ad modules and started making money. Is that kind of how you'd think about it? It just, all it needs to do is sort of flick a switch, and then they could start channeling some of the fees to users, and then it could be a capital asset that's generating actual earnings.
Yeah, so Uniswap is actually a really interesting example, because if you remember, Uniswap v2 introduced this protocol charge with like an on-off switch, which is governed at the time with some like ambiguous governance thing, and now it's like, oh, it's governed by uni holders, right? So the protocol charge is switched on. The 0.3% swap fee, 0.05% of that, so quarter basis point, or 0.25%, and then 0.05 is directed to a protocol treasury. So really what that money can be used for is really up in the air, right? That right now at the current earnings, or the current revenue, is about $45 million in annualized revenue to that treasury if the protocol fee was switched on. And you could use that in theory to burn or like distribute ETH dividends or whatever you wanted to do. You could, accrue that capital to the token holders. But that's not necessarily what's in like that social contract. I think like a lot of it's going to be used to like fund and incentivize like community contributions and the long-term development and growth of like Uniswap at large.
But what's interesting is like Kyber almost set a precedent there where like it did distribute over 70%. It is distributing over 70% to actual KNC owners, right? I wonder if Uniswap will follow a similar path. They'd at least have to be competitive with some of these other protocols in terms of what they distribute. Here's the price to sales, by the way, that I was missing earlier. And Uniswap right now is a 12 price to sales ratio. Which is absolutely crazy when you think of a Zoom at 411. Not quite apples to apples, but like kind of close. That's crazy.
All right, guys, we're about to get into the world of DEXs and see what happened with things like Uniswap and Curve in Q3 2020. We all know that DEXs absolutely blew up in Q3. But first, before we get to that subject, we're going to take a moment to talk about some of the fantastic Bankless sponsors that make this show possible. Unstoppable Domains has two products that's helping make the crypto world feel like the old world that we're familiar with, but with these new crypto economic protocols under the hood. And that is human readable crypto addresses as well as uncensorable domains. So I've got my Unstoppable Domains account open here, and I've got my domains registered. And so I've got davidhoffman.crypto, right? And I have one of my Ethereum addresses pointed to it. And I'm also going to be able to add my Bitcoin address here as well, because this is a blockchain agnostic product. Any wallet that has Unstoppable Domains integrated will allow you to type in davidhoffman.crypto. And if you're sending Bitcoin, or if you're sending ETH or Litecoin, or hell, even Ripple, it will send it to the address that I've associated on my account. So I'm going to pull up my Ether wallet here, and I've loaded up an address with a small amount of ETH, and I'm going to send a little bit of ETH to myself at davidhoffman.crypto. It's going to populate with the Ethereum address that it has, but it's also linked to my Twitter account because in Unstoppable Domains, I've linked my Twitter account to all of the addresses that I've plugged in. And so Chainlink is actually associating my Twitter account with my Ethereum address. And these are the Web 2 platforms that we have today, but think about what happens when decentralized identity becomes more of a thing. I'm sure Unstoppable Domains is going to use decentralized identity solutions like Bright ID or Circles to associate addresses with people in a extremely self-sovereign way. Unstoppable Domains also allows you to spin up uncensorable websites, which is, I think, going to become increasingly important in the world ahead of us. Using Unstoppable Domains, you can purchase a website and use decentralized storage providers to host it as well, meaning that no nation state can take down your website. There is no canceling in Unstoppable Domains world. They even have templates ready to go to help you build out your first unstoppable domain. So go to unstoppabledomains.com, register your crypto addresses with a human readable name, and maybe launch your uncensorable website today. ZAPPER is this new tool that I use to check out all of my assets in DeFi. As you guys have known, DeFi has absolutely exploded recently, and so managing your assets is getting harder and harder because there's so many different places and so many different assets that it could be. So I'm going to put my Ethereum address in here, and ZAPPER is going to tell me where all of my assets are across Ethereum, right? So here are all of the assets in this wallet. There's a decent amount of them. And it's also going to tell me where I've deposited assets into various DeFi protocols, right? So there's some yield farming going on. There's some liquidity pooling going on. We can also look more granularly at the specific protocols that it's involved with in this Explore feature. So it's got some assets deposited into Uniswap. It's got some assets deposited into Balancer. And also with ZAPPER, you can just exchange straight from the ZAPPER interface, right? So this is just another layer on top of Uniswap or other exchanges on Ethereum that allow you to swap assets, right? So check them out at zapper.fi. It'll give you a nice clean portal to invest your assets in DeFi. And you can also connect multiple wallets if you use multiple wallets all at once, and it'll give you an aggregate of every single wallet that you own. Check them out at zapper.fi. Also, this is definitely not my wallet.
All right, well, let's break this down by sector a little bit, Lucas. So maybe we'll come to ETH at the end if we have time, but decentralized exchanges, how did they do? I guess what are the sections that you outlined in this report? And then maybe let's start with decentralized exchanges, but like that's the first. What are the other sections? You got like derivatives and something else, right?
Right, yeah. So we did DEXs, lending, derivatives, and then we did some like miscellaneous highlights, namely with YFI and the Nexus Mutual.
Okay.
So in terms of like the DEX sector, pretty much led the charge, right, in Q3. I think overall, the DEX sector aggregated over $40 billion in volume in Q3, with Uniswap, comprising of like 25 billion of it. So a really solid portion of the revenue or the volume in Q3 was from Uniswap. I think like Curve was in second with 8 billion, and then Balancer with $2.7 billion in quarterly volume. So the DEX sector really led the charge. They killed it. A lot of the revenue is attributed, a lot of the DeFi revenue at large is attributed to the DEX sector. I can't remember what the specific number was. Yeah, $91 million of like the 108 was from DEXs. So
wow, they crushed it.
Do you want me to keep going on the DEXs here?
Yeah. Anything else on DEXs before we pop to lending?
We kind of talked about the Uniswap stuff. So that was kind of like my sector highlight, which was talking about Uniswap and how that protocol fee can be allocated towards like accruing earnings for token holders. So that was really the majority of it. Balancer had a really awesome quarter. I think they generated like $16 to $18 million in revenue to LPs, which given they launched back in like March, April, spring of 2020, that's pretty impressive given the short time span. But yeah, I mean, DEX is crushed it this quarter.
Uniswap and Balancer. So it seems like even in the DEX sector, it was automated market makers that really dominated in terms of revenue.
Exactly.
Very cool. All right, let's jump to lending.
Yeah, lending had a comeback quarter here. So let's see. Compound, I will say that like Compound and Aave, the way that the token terminal, who's the people that provided the data, the way they calculate the revenue is the interest accrued to suppliers, right?
Ah,
So it's kind of a nuanced thing where a lot of the revenue is really just going to people that supplied assets to the protocol, through interest. With that said, there's obviously an earnings mechanism that could be implemented there, where like a portion of that interest is accrued to token holders, right? Of Aave token holders or Comp token holders. That's not the case right now, but I think that was just an important nuance to kind of understand about lending revenues. With that, I think Maker was kind of the biggest highlight. They ended up turning on the stability fee after multiple months following like Black Thursday of 0% stability fee, not earning anything. MKR was diluted. It was a tough past couple months for MKR, but they're back on track now. There's nearly $1 billion of DAI in circulation right now. They're earning, somewhere around $70,000 to $80,000 per day, with the entirety of that being accrued to MKR holders, right? Because the DSR is not online. So all of that is going to earnings. MKR is kind of, back on track, to say the least, which is a good sign.
David, just on that, do you remember when we had Mariano Conti on a few months ago? I mean, this is back in April or so. And he made the bold, crazy prediction that DAI would hit 1 million or 1 billion, excuse me, in circulation this year. And that seemed absolutely outlandish and crazy.
Right.
And now here we are.
Here we are. Well, we're not there yet, but we are so close. You can taste it, right?
So close.
Very impressive. We're at
and I do want to make that distinction between Maker and the rest of the DeFi protocols. The DeFi yield farming, it was really a thing because of token issuance, right? And, while there is revenue going through these protocols, the reason why there was this DeFi mania was that because there was just a lot of issuance of valuable tokens, right? And I think what was going to come is a lot of those tokens, as Lucas just kind of alluded to, a lot of those tokens don't capture the revenue of the protocol. A lot of the revenue, like the Uniswap versus Kyber example, like Uniswap captures a lot of revenue and then redirects it to liquidity providers, not necessarily to the Uni token. And Maker had their token economics knocked from day one, where revenue from the protocol went into the token itself. And it's really exciting to see that get turned back on. So Maker as a leader of the protocol that is both generating revenue and also it accruing to the token, which it's supposed to be designed for, is the exemplar model that I think a lot of other DeFi protocols are either going to get to this point or not go anywhere at all.
Yeah, it's got 2 to 3 years of maturity on these other tokens. And you can kind of see that with it's going through its own cycles.
I will rip on Maker for a second though. I feel like their token economics is a little outdated. I feel like they could improve a lot on it, right? They could be implementing MKR rebates for paying stability fees, kind of like that yield farming mechanism for opening a DAI CDP. I feel like the auction, the MKR auction for burning is kind of not great. I feel like if they had a Uniswap with a ton of liquidity, implementing open market buybacks and stuff like that would be much more effective. But that's just my personal opinion. And I would love to see interest rates being set algorithmically rather than by MKR governance. So they're definitely killing it, but
all good points.
All
good points.
Yeah, they are taking this conservative approach at the same time. All right, let's talk about derivatives, who are not traditionally conservative types of assets. So what happened here?
So the derivatives sector, just in terms of the data that we had, was largely almost entirely synthetics, which they made a comeback. Their previous record of $1.9 million in quarterly revenue was kind of disproportionately reported due to front running issues. But they fixed that back in Q2, which is why you see that huge dip. And now they're kind of back on track. They almost exceeded that previous record almost all organically. And with that, you saw a pretty substantial increase in the outstanding SUSD, which is Synthetics' native crypto dollar. But yeah, I mean, Synthetics pretty much killed it. I will say Augur V2 launched, and then UMA's been doing pretty well. We don't have the data on that, but just from what I've seen personally, UMA's been definitely doing some interesting stuff out of that camp.
Yeah, I wonder how UMA token, UMA token looks from a revenue perspective. There's a few other things that I hope we get more data on in the future with Token Terminal, which is like MC Dex, which they did something last quarter, and they have their token as well. And then also, I kind of wonder what DYDX would look like if they actually had a token that accrued some of the value of their derivatives platform, because they're definitely doing a large amount of volume. So maybe we'll see DYDX. I feel like Antonio maybe hinted about that on our AMA with him, David. But yeah, we'll see when these other new derivatives platforms get added, how synthetics shapes up, because right now it's just dominating everything.
Yeah, we'll put a pin on the DYDX thing. I have a feeling they'll come out with something, but we'll see.
All right, so now we've got yield aggregators. Of course, we just got to talk about YFI. They just had a killer quarter. Some of those data are not in the data set that we were looking at, but what do you want to touch on with YFI?
Yeah, I mean, YFI pretty much had this meteoric rise in DeFi. Pretty much went from nothing in terms of like token value to over $1 billion in less than 2 months. Was pretty wild to say the least. And I think the most notable thing out of that was it kind of kickstarted or built upon the fair launch movement, which we talked about in a newsletter post before. But it's essentially this token distribution mechanism where you're kind of just building off the altruism of Satoshi Nakamoto and Bitcoin, and where everyone just has equal opportunity to earn the tokens. Like there's no founder allocation, there's no VCs, there's really no favorable, token allocation. It's really just equal opportunity for everyone. And I think that that fair launch movement kind of got kickstarted, and you kind of saw like YEARN Finance and all these other fair launches where there was just equal opportunity for everyone to kind of get a portion of that token supply.
And so, YFI is definitely a capital asset. We don't have the numbers in this specific report, but it is printing money basically. And I can't wait to see, as those numbers get incorporated, how much revenue it's actually throwing off to its holders basically. All right, the last one is NXM. So this is Nexus Mutual. So they had a massive quarter in terms of premiums paid.
Wow, that graph is up and to the right.
Yeah, Nexus Mutual killed it. It was actually interesting because like right at the beginning of Q3, like on like July 2nd or 3rd, they launched pooled staking, which is like this new way for NXM holders to stake against contracts and earn those premiums that are depicted on that graph. And that had this, transformational effect on Nexus Mutual. And kind of what you saw was this massive, run up in active covers and premiums paid. I think one of the interesting takeaways from that is Nexus Mutual right now has earned over $2 million in premiums from selling like insurance. And it's only paid out $35,000 in claims, right? So like that is insurance right there at its finest. If you were like wondering how the hell like insurance companies make money, like this is the math right here. Like millions of dollars made, only a few $1,000s paid out in claims. And I think that's really interesting, a really interesting takeaway when you're looking at Nexus Mutual.
Yeah, that's going to be an exciting protocol to watch. I'm pretty bullish about its future, specifically having talked to Hugh Karp, who's the founder of Nexus a few podcasts ago. All right, so there's also a number of untokenized protocols and applications. We mentioned DYDX, but there's also Instadap, which doesn't have a token, Open, Set, Zapper, Zerion. What do you think? Over under on whether some of these protocols are going to launch tokens? Yes or no? What do you think, Lucas?
I would say I'll take a while. I mean, do we count Index for Set protocol?
I do. I think I would. Set launched a token in Q4.
All right, so we can cross that one off the list.
One already has.
I would assume DYDX I would put it like a sure bet. I'm not going to say that, but I would strongly, think that DYDX would put out a token just to get competitive, just because he lost a lot of the market share in Q3 to like Uniswap and all these other DEXs. I'm interested to see how the asset management platforms kind of play out, like Instadap, Zapper, Zerion. Like there's not like some sort of set model, token model for them yet. So I'm very interested to see what happens there. And then open, we'll see. We'll see on open.
It's basically like, to be competitive, a token needs to be part of the incentive mechanism. It seems like that's what Q3 really showed us. Conclusions. Okay, so killer quarter, absolutely phenomenal quarter, but now we're down 50% on DeFi assets.
Sad.
So people are like, oh, it was a mania, as a one-time thing, bubble burst, bye-bye DeFi. Now we're really excited about Bitcoin and everything else, and ignored DeFi for a while. Did the bubble pop, Lucas? Or is DeFi kind of, did it do its thing and now it's dead?
I will say, what I will say, and I kind of outlined this in the report, is that this is a multi-year market cycle. Ethereum in the last market cycle had, over half a dozen, 30, 40%, 50% drawdowns. DeFi has only had one so far after this massive run up. So I would say that if you are, if you subscribe to that thesis that we're, at the beginning of a bull run, I think DeFi is like pretty much cemented itself that it's going to be, a critical part of this bull run. That said, you just never know. I think there's a lot of, profound and valuable mechanisms and distribution stuff. Like, as we talked about at the beginning, the rise of this ownership economy, I think will have, profound effects beyond just DeFi and crypto at large. So I think this is just the first drawdown of many to come after multiple run-ups. So we'll see.
Very good, Lucas. Well, you crushed it on this report, my friend. This, I think, is one of the best reports, if not the best reports on DeFi in the space right now. It is institutional level. So you could send this to, your investor friend who's tinkering with stocks, and they should be able to understand the terminology. Once again, you can get it on Bankless. Just type in Bankless Q3 token report in Google and bankless.substack.com. Lucas, thanks a lot for walking us through that, my friend.
Of course, this is awesome to do. So thank you guys for having me on.
I appreciate it. Looking forward to Q4.
All right. Appreciate it, guys. Thank you.